Have you ever wondered how your money grows in a bank, or where it goes when you deposit it, and how safe it really is? In today's video, we will demystify the world of banking. Stick with us, and you'll soon understand more about these essential institutions. Thanks for knocking the rich door and welcome back to our channel. Today we're diving into a topic that touches everyone's lives but can be quite confusing: how banks work. By the end of this video, you'll have a clearer understanding of the inner workings of a bank, and you'll be able to explain it to your friends too. The concept of banking is thousands of years old, dating back to ancient civilizations. The term bank comes from the Italian word banca, which means bench. The early bankers, known as money changers, conducted their business on benches in marketplaces in the cities of Europe. The history of banking begins in ancient Mesopotamia, where temples and palaces often served as safe places for the storage of valuables. Priests kept precious items and grains for their community and lent them to traders or farmers in need. In ancient Greece, the temples also conducted financial transactions, such as lending, changing money, and even validating coins' authenticity. The growth of trade in the Mediterranean area led to the development of so-called moneylenders' practices. In Rome, more complex banking functions evolved. Loans were advanced to customers, and deposits were accepted. In the Roman Empire, a more sophisticated banking system developed with the rise of a class of wealthy individuals who involved themselves in the financial operations of the government and others, such as tax farming and construction. By the Middle Ages, the use of credit and banking functions had become widespread in the growing cities of Europe. The Knights Templar in the 12th century created one of the earliest forms of banking by providing pilgrims traveling to the Holy Land with letters of credit, which could be exchanged for cash at Templar sites along the journey. The development of banking was slow and haphazard until the formation of joint stock banks and the issue of paper money. The Bank of England, established in 1694, is often cited as the first modern bank. It began as a joint stock bank with government funds and soon became the model for modern central banking systems with its issue of legal tender. The idea of banking continued to evolve in the 18th and 19th centuries with the spread of industrialization. In the United States, the Federal Reserve System was established in 1913, providing the nation with a safe, flexible, and stable monetary and financial system. From the use of temples as storehouses in Mesopotamia to the global network of financial institutions today, banks have come a long way and become an integral part of our economy and everyday life. Banks come in many shapes and sizes, each designed to serve different needs. Let's break down the main types of banks that we see today. Commercial banks. These are the most common type of banks that we interact with on a daily basis. They offer a broad range of services to both individuals and businesses. This includes savings and checking accounts, loans like mortgages and auto loans, and other services such as credit cards and safety deposit boxes. Big names in commercial banking include Bank of America, JP Morgan Chase, and Wells Fargo. Investment banks. These banks are involved in large, complex financial transactions. They assist companies with services such as underwriting new stock shares, handling mergers and acquisitions, and providing advisory services. They also trade securities for themselves or their clients. Goldman Sachs and Morgan Stanley are two well-known investment banks. Retail banks. These banks focus on individual consumers rather than businesses. They offer services like checking and savings accounts, personal loans, mortgages, and credit cards. Many commercial banks also provide retail banking services. Credit unions. These are not-for-profit financial institutions owned by their members. They offer many of the same services as commercial banks, but profits are returned to members in the form of lower fees and higher savings rates. Online banks. As the name suggests, these banks operate entirely online or through mobile applications. They usually have lower overhead costs, allowing them to offer lower fees and higher interest rates on savings accounts. Examples include Ally Bank and Chime. Savings and loans, SandLS, and mutual savings banks. These banks originally had the primary purpose of taking savings deposits and providing home mortgage loans. Now, many offer services similar to commercial banks. Central banks. These are not like the other types of banks. They manage a nation's money supply, set its monetary policy, and act as a lender of last resort. They don't provide services to individual consumers. Examples include the Federal Reserve in the US, the European Central Bank in the Eurozone, and the Bank of England in the UK. Each type of bank plays a crucial role in the financial system, serving different needs but all facilitating the flow of money in the economy. Banks, like any business, exist to make a profit, but the ways banks make their money might surprise you. Let's break it down. Interest income. The primary way banks earn money is through the interest they charge on loans. When you take out a loan, whether it's a mortgage, auto loan, or personal loan, the bank charges you interest on the amount you borrow. This interest rate is usually higher than what they pay on deposits, creating an interest spread. For instance, if a bank pays 1% interest on savings and charges 4% interest on loans, it makes a 3% profit on the funds it lends out. Fees and commissions. Banks charge fees for many of their services, which contribute to their income. These can include account maintenance fees, ATM fees, overdraft fees, late payment fees on loans, and fees for issuing checks. They also earn commissions from providing certain services like wealth management, brokerage services, or arranging insurance policies. Interchange income. Every time you use your debit or credit card, the merchant pays a small fee, called an interchange fee. A portion of this fee goes to the bank that issued the card. These fees can add up to significant income for banks with millions of cardholders. Investment income. Banks invest some of the money they hold in various types of assets, like government and corporate bonds, stocks, and real estate. The returns from these investments add to their profit. Foreign exchange. Banks buy and sell foreign currencies. The difference between the buying price and the selling price, known as the spread, provides another source of income. Treasury operations. Banks have large treasury operations where they deal with other banks, financial institutions, and the central bank. They often borrow and lend amongst themselves, and the interest differential also helps in generating income. So, the next time you're using your bank services, remember that these are all parts of a vast, interconnected system designed to keep the bank running profitably, allowing it to serve you, its customers, while also making a return for its shareholders. Banks are much more than just places to store money. They play a crucial role in our economic system by facilitating the flow of funds and providing financial services. Here's a closer look at how they operate within the system. Accepting deposits. Banks accept deposits from individuals and businesses, offering a safe place to store money. Depending on the type of account, they may pay interest on these deposits. Providing loans. Banks lend out a portion of the deposits they hold to other customers who need more funds. This might be a business looking to expand, a family buying a home, or a student paying for college. The interest and fees on these loans are a primary source of income for banks. Creating money. Through a process known as fractional reserve banking, banks can lend out more money than they actually hold in cash. This effectively creates new money and is how most of the money in the economy is created. Payment system. Banks operate the payment system, which allows customers to transfer money between accounts, both within the same bank and between different banks. This includes services like online banking, wire transfers, and debit cards. Financial services. Banks provide a range of other financial services like foreign currency exchange, financial advice, wealth management, insurance, and more. Regulation and central banks. Banks are regulated by governmental bodies to ensure they're operating safely and fairly. Central banks play a key role in this, overseeing the banking system and managing the money supply to help maintain economic stability. By performing these functions, banks play a critical role in the economy. They allow funds to flow from people who have excess money to those who need it. They enable businesses to grow and invest, and they help individuals to manage their finances and achieve their financial goals. Looking at real-world case studies can help us understand how banks operate and their impact on our society and economy. Let's explore a few notable examples. Case Study 1. JP Chase & Company. This is one of the largest banking institutions globally, offering a wide range of services from retail banking, like checking and savings accounts, to investment banking and asset management. JP Chase illustrates how diverse and multifaceted large banks can be. During the 2008 financial crisis, it acquired failing banks like Bear Stearns and Washington Mutual, demonstrating the consolidation trend in the banking industry during crises. Case Study 2. Wells Fargo fake accounts scandal. In 2016, Wells Fargo, another massive U.S. bank, faced a huge scandal when it was discovered that employees had opened millions of fake accounts in customers' names without their consent to meet sales targets. This case shows how banks can sometimes act against customers' interests and the importance of regulatory oversight in the banking industry. As a result, Wells Fargo paid billions in fines and underwent significant structural changes. Case Study 3. The rise of challenger banks. With the growth of technology, we've seen the rise of online-only or challenger banks, like Monzo in the UK and N26 in Germany. These banks have no physical branches, offering low-cost, user-friendly services. They highlight how technology is disrupting the traditional banking model and meeting the changing needs of consumers. Case Study 4. The Cooperative Bank. This UK-based bank is notable for its ethical approach to banking. It's a customer-owned bank that prides itself on having a clear customer-led ethical policy. The cooperative bank shows that banks can take different ownership structures and business models. Case Study 5. Bank runs during the Great Depression. During the Great Depression of the 1930s, a lack of confidence in the banking system led to widespread bank runs, where a large number of customers withdraw their deposits because they fear the bank might become insolvent. This case illustrates the importance of confidence in the banking system and how deposit insurance has been put in place to prevent such scenarios. These case studies illustrate the broad range of operations within the banking sector, the potential for missteps, the impact of technological innovation, and the vital role of regulation and customer trust in maintaining a healthy banking system. So, that's a brief look at how banks work. They're more than just a place to store your money. They are critical cogs in the economy, helping to keep money flowing, offering loans to help businesses grow and individuals achieve their dreams, all while keeping our deposits safe. Thanks for watching. If you found this video insightful, Please give it a thumbs up and share it with your colleagues. Don't forget to subscribe for more business content.